Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com warns yield curves are inverting and what that means to the economy down the road. In the meantime, markets are positive about the pause in interest rate hikes. WolfStreet.com publisher Wolf Richter dives into the debt crisis facing much of the industrialized world. He also comments on who is at fault in the trade war between the U.S. and China. John Rubino, author of the book The Money Bubble, takes a look at the monstrous debts nations have piled up and how they have failed to come up with any logical way to deal with the problem. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Nice to be with you, Jim.
Ross, the yield curves are starting to invert. Is that a warning sign for the markets?
Oh, it definitely is. When we've seen inversions in the past, and you go back to 2007, 2000, and then 1998, it's the inversion of the curve that invariably precedes an economic downturn. But it can be by as much as a year to a year and a half. So what we've got in the Canadian market right now is that about half of the Canadian curve is inverted. Everything out to about the 20-year shows an inversion. So you've got the interest rates on that 5-10-year window out there are lower than they are right at the front end in terms of what the Bank of Canada is lending out at. In the U.S. side, you're also seeing an inversion there. Right at the front end, the 2-year versus the 5-year has an inversion. The 2s versus the 10s, no inversion there. It's about a 17-point premium on the 10 years over the 2s. But getting up towards the level of it possibly being inverted. So the key that you want to keep an eye on here, and we will be for in the coming months, is that if those curves start to widen back out again, away from inversion, that has been the major sell signal as far as the equity markets have been concerned at the last 3 times that we've had this in the last 20 years or so. So we're going to keep that in the back of our minds and see how it evolves over the coming months.
How are the FANGs doing on the stock market?
FANGs have really come right back to life again. You've got Amazon, Netflix, just starting to see some good price action, and that was after a pretty poor stretch from June through December. If anything, they kind of led the market to the downside into that December bottom. But they're coming back well. Anything in the semiconductor area, just doing gangbusters on the upside. And even during the week, we had coming off that December low, the December 24th low. Market went pretty much straight up until about 10 days ago, and then had a minor correction. So we had a minor oversold at the beginning of this week, and that's what we classify as a springboard. When you get that minor oversold, and the first time you get one after the 20 and the 50-day moving averages are crossed, or if it's a 20 and 50-week moving average if you're looking at a longer-term chart. But that first time that you get a good oversold signal, you invariably go back to retest the highs and take that out, which is what we've seen at the tail end of the week here. So pretty decent looking market. You know, and the only real point that you saw any pressure was over in the Dow, which was being held back by Boeing, and related to the Ethiopian air crash, which, you know, it's just terrible that you've had so much loss of life in two of these Boeing 737s. But we always take a look at major events like that, and you know, whether it's a crash like that or the deep sea horizon problems in the Gulf a few years ago, you take a look at the action in the equities, and they invariably will overshoot in the initial stages because people are thinking of absolute worst possible scenarios as far as what it might mean to bottom lines on the companies. And what happens here is that the option premiums, the puts and call premiums, expand very, very significantly. The options on Boeing went out so that we had a 30 to 40% implied volatility, which is extremely high for a stock like Boeing. So at the optimum trade, when you see that kind of action and you get a good oversold, and we did have some just excellent oversold readings in Boeing on Monday and Tuesday, is to go out and sell that premium, take in the premium, so that as the stock starts to consolidate, the premium comes out. And if one was to have sold puts on Tuesday, which we had done for our own account, those options are today trading at about 35% of what they were. So it's been really good, quick erosion of premium there. And for somebody who's looking for maybe something a little longer in terms of a hold, you might take a look at being short the out-of-the-money calls like the Boeing 420s, and also have the Boeing 340 puts short and earn some nice time premium there. Because as we move down the road here, maybe over the next 3 or 4 months, and Boeing resolves whatever it has in the way of software issues, stock will, be looking to stabilize, but probably, not make any major moves. So take in some time premium, let the market work for you, rather than trying to pick a direction.
Gold, how's it doing?
Gold had a really nice bounce off that Fibonacci retracement. As you know, we'd had that nice rally up to 1350, corrected back to 1280. That was a week and a half ago. So we got some nice sequential buy signals down there, and you got a 38% retracement rally back to 1310. Now that 1310 area is, I think, going to be significant in terms of resistance right now. We could very easily, on the downside, see a test of 1265, which would be giving back half of the gains from the August bottom. And don't forget, we're past the best part of the seasonal. The seasonal is usually very strong, December through February, and as you get into the second half of February, it tends to tire out. This year has been pretty much right on track with the normal seasonal. So the consolidation here with maybe one more leg down into the 1265 area would be worth taking a look at. We see that the platinum stocks, Sabapne, PTM, are holding up very, very nicely in here. So I think that there might be some nice plays over in platinum.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Wolf Richter next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, is modern-day slavery debt slavery? And where are the most indebted slaves?
Yeah, debt slavery is sort of a modern version of slavery, because when you have too much debt, when households have too much debt, it limits what they can do, how they can operate in the economy. It focuses their entire life on dealing with their debt, and so large debt burdens on households have a very negative impact on the overall economy. We saw that in the United States during the run-up of the financial crisis. And there's several measures for the burden of debt on households, and one of them is to calculate household debt as a percent of the overall economy as measured by GDP. So this is the household debt to GDP ratio. And there are other measures, but this is one of them. And in terms of this ratio, the United States had households at 70%, household debt at 70% of GDP in 2001. So it's relatively low. It was no problem. And then households went on a borrowing binge, and by 2007, it had reached 100% of GDP. And we know what comes next. It's that house prices fell. And so debt that was backed by these homes became problematic. And we had the mortgage crisis with about 10% of the mortgages defaulting, which helped trigger the financial crisis, which helped trigger the global financial crisis. So for a big economy like the United States to end a problem like that, it has global repercussions. Since then, American households have learned a lesson. A lot of the debt has gotten rid of by default and bankruptcies and so forth. And in terms of the overall economy, the GDP has grown in the United States, but household debt has essentially remained flat. So now the household debt to GDP ratio is down to 76%, which is among developed economies is relatively low. But the lesson that was learned during the financial crisis for American households. And other countries haven't quite learned that yet. Canada, so this puts the United States in the 11th place globally in terms of household debt to GDP. Now, Canada is in 6th place. And Canada never went through a real financial crisis the way the United States did. There was no mortgage crisis and no housing crisis. There was just a little dip in Canada. And the housing boom essentially just continued, and as did household debt. Interest rates were lowered at some point, and which encouraged more borrowing. So Canadian household debt boomed, and in terms of debt to GDP ratio, it went from 60% in 2000 to 2002 to just over 100% by 2017, and it remained at over 100% now. The 100% line is the line where the United States started tripping up. So this is a pretty critical situation for Canadian household debt. This is, but it puts Canada in 6th place, so it's not even the worst. In terms of what's between the United States and Canada, there's the UK and New Zealand and South Korea and a couple others. So they're all coming up. In terms of going to number 1, we're going down the line here a little bit. Norwegian debt slaves, and I call them debt slaves because they're really tied to their debt. They're in 5th place now. at about the same level, over 100% debt to GDP. Now, the Netherlands is back down to fourth place. It was second place. They reached a debt to GDP level of 120% just during the Euro debt crisis. And what happened there is that the economy went into a tailspin during the Euro debt crisis, and household debt, as interest rates were pushed down, increased, and that caused the debt to GDP ratio to spike to 120%. This has since hobbled the economy in the Netherlands, and households have tried to deleverage, tried to deal with it. Household debt to GDP has now dropped to 102%, but it comes at an expense of the Dutch economy. Now, the Danish were number one with a debt to GDP ratio of 140% during the Euro debt crisis. That had some severe impact on the Danish economy. They went through two tough recessions. Their GDP, the economy has never really fully recovered to the level before the Euro debt crisis. Their household debt is just so large that households are really tapped out, and they're trying to back out of it now. Their debt to GDP ratio is down to 116%, which is still sky high. And it just limits what Danish households can do, and so the economy just kind of hobbles along. And the two prior recessions that they had, so the Euro debt crisis and the recession that followed after that, were severe. Yeah, and Denmark has a very large safety net, so a recession in Denmark doesn't have the same impact as it has in the United States because of the large safety net and the large involvement of government in the economy. So the people actually didn't really feel it that much, but in terms of the economy itself, it never really recovered fully from the Euro debt crisis. And now Australia is number 2 in terms of debt to GDP, household debt to GDP, and that is largely because of their property boom. And in Australia now, home prices are falling, and that started in 2017. In some parts of the Sydney metro, home prices are already down over 15%, and they're falling really in most major markets across the country. So that debt that is backed by these homes is not getting in trouble. The banking system in Australia is in a deep crisis. They engage in all kinds of shenanigans, including mortgage fraud and other things that the Royal Commission has now brought to light. And so there's a lot of regulatory pressure on banks to clean up the act. And so they can't lend as freely anymore as they used to. And there's a little bit of a credit crunch going on in that, underwriting standards have been raised and not everything flies anymore. And so there's a tremendous pressure now on the Australian housing market, both from the banking sector that regulators are trying to clean up, and from home prices that are now turning south in Sydney and Melbourne at astounding rates. I mean, this is really going down fast, and it doesn't look like it's going to stop. I mean, it's just a line south that is very steep, and it just started recently. Home prices move fairly slowly, but in terms of what we've seen, this is the fast move. So the Australian debt is going to be a problem. And now, if there's a financial crisis in Australia, and there's likely going to be one, and the IMF has already warned about it, and the Australian economy is pretty small, and it's not as interwoven into the global economy as the United States is. So a financial crisis in Australia isn't going to have huge global impact. And that's the good thing. I mean, there's financial crises all the time. It's just when it happens in the United States or in a big place like China, or in Japan, that it would have a global impact. But in a small economy like Australia, it's not going to have a global impact. But that's what they're looking at. They're looking at a financial crisis in Australia, and simply because household indebtedness is so enormous, and the banking crisis that is now going on sheds serious doubts about the banking sector. Now, number one on this list Switzerland, and their debt to GDP ratio is 129%, which is huge and gigantic and still rising. The Swiss aren't even big homeowners. They're about half of the people there are renters, but the people that do own homes, they own rental properties too, and so the indebtedness is very large. Interest rates the policy rates from the central bank are below zero. Mortgage rates are very low at 1 to 2%. So that encourages borrowing, and it has created a housing bubble in Switzerland. But it leaves households so indebted that it is now practically impossible for the Swiss National Bank to raise interest rates at all. I mean, this is where the term debt slavery comes from. It limits your options. Suddenly, the economy overall, as well as households, have limitations that they didn't have before. There are a lot of things that they can't do anymore, and the central banks are boxed into a corner. So debt has this impact, and it's a constriction on how an economy can move.
We'll have more with Wolf Richter when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN.V. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, Canadian homeowners make extensive use of home equity lines of credit, HELOCs. How are homeowners in the U.S. stacking up in comparison?
Canadians have had a benefit that American homeowners haven't had. The benefit of not going through a financial crisis and a mortgage crisis. So HELOCs in Canada are now running HELOC balances, so this is money owed, running at around 300 billion Canadian dollars right now. And that's up by about 35% over the last 5 years. So it has really surged. Comparatively speaking, in the United States, our HELOC balances have peaked in 2006, and then dropped a little bit, and then peaked again in 2008, and that was the final peak, and have since crashed around 40%. So they're now at 346 billion US dollars, which is about 460 billion Canadian dollars. So let's compare that a little bit. When you look at the chart, it's really the opposite. And the Canadian HELOCs just continue to rise. And the US HELOCs, they final peaked in 2008, 2009, and have since then plunged. And so let's look at the quantity. So for the United States to owe, in Canadian dollars, you owe 460 billion on its HELOC balances. That's 1,400 Canadian dollars per capita, per person in the United States. There's about 9 times as many people in the United States as there in Canada, so a lot more population. So 1,400 Canadian dollars per capita in the U.S. In Canada, it's about $8,100 per capita. So that's the difference. There's about per capita, there's close to 7 times as much HELOC debt in Canada as there is in the United States. And HELOCs can be a good way to finance home improvements, for example, or the asset value that you're spending money on stays with the mortgage. So if you have a house that's $1 million and you spend $100,000 on it to improve it, and you borrow that $100,000 on the home equity line of credit, the value of the house increases not by $100,000 because improvements never show up in the value to that extent, but it'll increase by some, depending on what you work on. But if you use that money to go on vacation or live off or some other way, you become very dependent on home prices not going down. And as we have learned in the United States, that's not always the case. And now we're seeing home prices decline in Vancouver, and there's other weaknesses in Canada popping up. And so when you default on a HELOC, it's a secured credit. It's not like a credit card where the lender can sue you and can get a judgment, and then you can declare bankruptcy, and you go through this process. Now, HELOC, the lender can foreclose on the house. So if you default on a HELOC, you can lose the house. And that's what happened to lots of people in the United States. They lost their homes in part because they used the homes as an ATM. They drew cash out of it during the good times via the HELOCs, and when prices declined, there was no equity left, and they had trouble. They couldn't make the HELOC payments. And it led to a default, and then it caused all kinds of problems. And it's a very painful experience to go through. So in Canada right now, the indebtedness is such that it exceeds on a per capita basis what it was in the United States before the financial crisis. This is a really worrisome trend. It's a high risk debt in the sense that you can lose your house over it, and the lender doesn't really have to go to court. There's a foreclosure process in place, and they just follow that. And depending on where you are, the processes are different. In some places you have to go to court, in other places you don't. But it's a prescribed process that's pretty regulated, and you end up without your house. So we look at the HELOC as a good way to borrow if you have plenty of equity left in your house. It's a cheap way to borrow, and if the money is reinvested in the house so that the asset price goes up a little bit. But if you use your HELOC money to fund consumption, you can run into serious problems, and that's what the Americans have learned. And that's why. Then the lenders are very aggressive in the United States, trying to make people take out HELOCs. It's a good business for the banks. And if you look on the internet, every time there's full of ads, and you get the junk mail about HELOCs, and they're really trying to get you to borrow on your house. And the Fed has come out. William Dudley, when he was president of the New York Fed last year, he said that. Americans should do that. They should borrow against their home equity and spend this money to help the economy. I mean, the Fed wants people to go into debt to consume, and at the same time, this is what caused all the problems, or it's caused part of the problems in the run-up of the financial crisis. So, Canadians are just missed out on that whole experience, and so. This is something that Americans have, it's just completely burned into their brains, that the risks of taking out these home equity lines of credit and blowing the money on vacation and other things. And so there's not that many things in the economies of Canada and the United States where there's such a diametrically opposing trends as we have with the HELOCs. I mean, it just goes in completely the opposite directions. And with Americans shedding them, and with Canadians adding them, and and the risk levels in Canada are now very, very significant, and that's something to worry about.
We'll have more with Wolf Richter when This Week in Money returns.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, international trade has been front and center on President Trump's agenda. How have those efforts worked out for the U.S. so far?
Yeah, so 2018 was the second year of the Trump administration and the second year of its efforts to deal with the U.S. trade deficit. Now, the U.S. trade deficit has been a problem since the late 1990s, and at first it was just brushed off, and no president really has tried to deal with it. So I think it's to Trump's credit that he's put it on the table, but it looks like the administration is totally bungling the approach. First things first, the United States had a $20 billion trade deficit with Canada in goods and had a surplus with Canada in services. So the overall trade balance between the United States and Canada was roughly balanced. And that's as good as a trade partner as you can imagine, because there's a huge bilateral trade going on between both countries. And when the trade is as roughly balanced as it is, that's really a great relationship. So I don't know how, and there's always disputes between trade partners, on every little thing. There's squabbles. And there are mechanisms in place to solve these squabbles, and they will continue to go on, because each country has its own industries that want to be protected, and they're clamoring for their governments to do something about it. And so, those stuff will go on, especially between neighbors. That's unavoidable, and there are mechanisms in place to deal with it. But that's not the issue for the United States. The issue is China. And there Trump has really bungled the debate, because China is not forcing the United States to buy its products. What is happening is that corporate America has transferred a big part of the supply chain to Asia, and including China and largely China, and more and more of the products that go into products that are manufactured in the United States and that end up on the shelves and stores coming out of China. And that includes auto parts, auto components. It includes all kinds of retail products that come over as finished goods, and a lot of iPhones and those kinds of products are made in China. And so the United States has a ballooning trade deficit with China. And the problem there is that it's not a bilateral trade. China is just it's just like a one-way street. So the trade deficit with China, and I use China and Hong Kong together because of the transfer shipments and the invoicing through Hong Kong. So really we need to net them out. So China and Hong Kong together, the trade deficit that the United States has with them was $390 billion in 2018. That is huge. It's just a gigantic amount, and it comes from the fact that the China and Hong Kong combination buy very little from the United States, and we get a lot of our merchandise from there. So it's a very unbalanced relationship. Part of that problem is in China, and Trump is trying to address that. It includes the joint venture requirements if U.S. companies are trying to set up shop there. It includes to require technology transfers and those kind of things. And China needs to be hounded for those issues, and that's correct. And I'm glad Trump is finally doing that. Other presidents have been pussyfooting around that issue. The other issue is corporate America, and yeah, this is probably the most pro-corporate America administration that I've ever seen. And so they're not going to really do anything substantive about it. And that's what we've seen in 2017 and 2018. Corporate America has continued to transfer its supply chain over to China and at an increasing pace. There are tax advantages for them to do that. China has cheaper labor. There are other reasons for them to do that. And these issues can be addressed. And they can be addressed, first of all, by directly naming corporate America as the primary issue in this. Because, yeah, nobody forces American consumers to buy Chinese products other than American companies that put it on the shelf or American companies that include it in the product. So when you buy a Ford assembled in the United States, you'll have major components in it that were made in China. And much of the auto manufacturing component industry after the industry collapsed in 2009 was transferred to China. You know, as American companies, GM and Ford, that moved the supply chain to China. And so that's what we're seeing here. And so the attempt to put tariffs on these products is a tax on corporate profit margins. And the corporations have gotten a huge tax cut starting in January 2018. And that tax cut should have been packaged together with the tariffs. So you say, okay, we're going to lower the taxes on your profits, on your net profit, but we're going to raise your taxes on your profit margins if you import merchandise from overseas. And it's sort of like a sin tax. You know, you tax alcohol consumption and you tax cigarettes and those other things. So, yeah, you allow this behavior, but you're going to pay a little extra. And you take away the tax incentives that are in the tax code for American companies to offshore production. And companies can then decide what they want to do. Now, there's not a tax on consumers. That's how it's been pitched by those opponents. But, you know, the companies cannot pass on tariffs. Yeah, the prices are not set by corporations. The prices are set by competition in the market. So, when General Motors decides to import the Envision SUV from China, it competes with American-made and Canadian-made and Mexican-made SUVs. So the prices are set by the competitors. They're set by everybody else in the market. And they're not going to raise the prices to allow GM to pay the tariff on its imports. So, this is a bogus argument that tariffs are a tax on consumers. There are a tax on profit margins, on corporate profit margins. And just like corporations have not passed on their tax cuts that they got, corporations cannot pass on the tax increases they get. And it just can't happen. Prices are set in the marketplace. But, and I've written to the White House about it, and I've gotten, the standard kind of response. But, this is the problem that is now really spiraling out of control. And the Trump administration is so pro-America, so pro-corporate America that the trade deficit will just continue to increase because it's corporate America that's causing this. It's not other countries. You can't blame China for doing what it does. It's got cheap labor and it's got very efficient manufacturing production and it's got all kinds of things, that make production over there pretty cheap and they've got good infrastructure in place to ship it over here. And you can't blame them for creating this environment. What you can blame, is the tax code that encourages American companies to take advantage of that. And you can take the tax incentives out of it and make American companies think a little bit more about where they're going to source the components and the parts and the merchandise. And that's a very important question for companies. They always try to increase their margins every day and every time. And so if you put tariffs on the margins, they will try to avoid that. And that will cause them to start looking at suppliers within the United States or within the tariff-free trade areas such as with Canada and Mexico.
Wolf, can you tell us a little bit about Wolf Street?
WolfStreet.com is free. We just focus on finance, business, and economics, no politics, and everything is always available for free.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. Coming up, John Rubino, next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol AESDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to This Week in Money.
Hey, Jim. Thanks for having me on.
The U.S., are they on the edge of a recession?
Well, that's part of an interesting story that's basically global at this point, because 3 or 4 months ago, it looked like all the world's central banks were about to join the U.S. and Canada in tightening, because their economies were growing strongly enough to justify raising interest rates, and they really did want to raise interest rates to give them some ammo to cut in the next recession. But in the ensuing few months, stock markets got volatile all around the world, and a lot of the economies out there started to slow down. And that caused the big central banks, and I'm including Europe and Japan and China in that category, it caused them to scale back their plans to tighten and actually move to further easing. So now we've got the U.S. no longer tightening, and the other big central banks actively easing. So we're back in, 2012 level central bank policy ranges now, where everybody's pretty aggressively easing. And to get back to your question about whether the U.S. is in a recession or not, that's part of why things started to slow down dramatically. You've got real estate in the U.S. no longer rocking. A lot of the trophy properties are actually falling in price. Some of the hot markets are no longer increasing. Home sales are down. Home building is down. Mortgage applications are down. So it looks like real estate is starting to roll over, and car sales are down, in part because we lent money to anybody with a heartbeat to buy a car in the last few years. And so they basically have locked themselves into car mortgages that go for 7 years now. There's nobody left to buy. So that's slowing down. Student loans have reached a point in the U.S. where people with student loans aren't able to buy anything else. That's why there isn't a lot of home buying right now at the low end of the market, because people with student loans have already taken out all the debt they can take out. They can't take out a mortgage. So toss it all together, and you get a not a recessionary economy yet, but a slowing one. And it's kind of the same thing around the world. Germany's economy is slowing dramatically, and their inflation just came out at like 1.7%, which is below the ECB's target rate, which gives the ECB some cover to loosen further. But remember, that's Germany. And if Germany's in trouble, the rest of Europe is in big trouble, because Greece and Italy and Portugal and Spain, and to a lesser extent France, they're always in trouble financially, and it's always Germany who bails them out. So if Germany's not in great shape, in other words, generating lots of new jobs and massive budget surpluses and huge amounts of new cash to save everybody else, then Europe's got problems. And Japan, of course, has borrowed so much money that they can't inflate, which is what they need to do. They need inflation to make their debts manageable, but they can't get it, no matter how low interest rates are, no matter how much the government borrows. So they have no choice but to ramp it up. So anyhow, the global economy is slowing down. Central banks are responding to that with an end to tightening, to the extent there ever was tightening, and then aggressive ease from there. So we're heading into really uncharted territory where we've had a whole cycle, a whole 10-year expansion without monetary tightening on a global basis. And we're heading into the next recession with 0 to negative interest rates in a lot of big countries and massive budget deficits already. The U.S. is running $1 trillion deficit 10 years into a recovery. So that the normal tools that governments have used in the past to combat downturns have already kind of been used, which leaves these guys with the only option, being doubling down. In other words, if you used to double your deficit in order to combat a recession, but you've already doubled your deficit in the last couple of years of the expansion, then that means you've got to, in effect, quadruple your deficit spending from the lowest point in the previous cycle. If you normally cut interest rates by 5% from peak to trough in order to combat a recession, but your interest rates are already at 0, that means in the next recession, if you're going to cut interest rates, the normal 5 percentage points, you've got to take your interest rates down to negative 5%, which is completely uncharted territory. We have no idea what would happen if the major economies had negative 5% interest rates. A few of them got away with negative 0.5 point interest rates this time around. But presumably, there's a lower limit. There's some kind of a number that just doesn't work anymore when you start cutting interest rates into negative territory. And we don't know what that is, but we might find out this time around. So this, from a theoretical standpoint, is absolutely fascinating. But when we hit the point where it doesn't work anymore, then it'll go from intellectual interest to the real world. It will be terrifying for everybody to find out that the usual tools that the government has to fix things when things go wrong don't work anymore. So what happens then? The answer is, who knows? It probably won't be good, but we really can't know with any kind of specifics what the world will look like when we've got negative interest rates, massive deficit spending, massive quantitative easing programs, and they don't work. So we'll see. So very interesting times, Jim. Terrifying times, but interesting times.
Well, I wonder, with negative interest rates, how do you take out a mortgage? Does the bank pay you?
Yes. The short answer is yes. With negative interest rates, the borrower gets paid. So mortgage rates in the U.S., which is the only set of mortgage rates I really know anything about, dropped into the 3s this time around. So if we were going to take the 10-year Treasury bond yield, which is what mortgage rates key off of, and drop that rate by 5 percentage points going forward, then that would take mortgages into negative territory, where if you buy a house, you get a check every month for living in that house. Now, theoretically, that would spur a lot of borrowing, right? This last time around it did. When we had low to negative interest rates, a lot of people borrowed a lot of money. I actually, personal story here. I bought my kid a car and decided to finance it so he could experience paying off a loan. The car would be in my name, but the loan would be his to pay off. And so I went to the car dealer and said, yeah, we'll finance this, okay? And the guy came back and said, okay, we can give you a 2% interest rate on a car loan, on a used car, 2%. So that made it very painless for me to borrow money. And that probably works that way across the rest of the economy, where people, who probably wouldn't do something for a 5% interest rate, look at 1 or 2% and think, God, that's basically free money, I might as well. It's almost 0% financing, like the car companies sometimes offer as a perk. So I might as well borrow that money and do something with it. So the the idea is that cutting interest rates to that level will lead to a burst of borrowing and spending and give us economic growth. The problem with that is that works for a certain level of societal debt, but stops working when we've borrowed a critical amount of money that makes borrowing new money prohibitively scary for most people. Or just it makes you such a bad credit that nobody in their right mind would lend you money. More and more people fall into that category as more and more debt is taken on. So a society reaches a point where even at negative interest rates, you don't get the amount of borrowing that you were hoping for. And the people who do borrow then tend to move from being a good credit to a less good credit and from a less good credit to a bad credit because they're taking on more and more debt. So you reach a point where it doesn't work anymore, in other words. And we'll find out how that works coming up. We really don't know what doesn't work in terms of how negative interest rates can go and how much a government can borrow in this world. But we know that historically, excessive debt has blown up the currencies of lots of other countries. You know, we've had multiple hyperinflations in the history of markets in which countries decided to borrow a whole bunch of money, and then they had to create a lot of new currency to cover that new debt, and the oversupply of currency made its value fall, and then that blew up the financial system of that country. Well, we're doing that on a global basis now, and we're getting away with stuff that nobody could get away with before because we're doing it in a coordinated way. But that just moves the problem one level up to a bigger scale. In other words, you know, we're adding a zero to the power function. But it doesn't change the basic rules of finance, which involve excessive debt leading to problems. So the world is taking on way too much debt. It's creating way too much currency in order to finance that debt. And at some point out there, there's a wall that will hit. And again, because it's a global screw-up this time around, we don't know how far away that wall is. But you know what? If we try to cut interest rates to negative 5% next time around, we could hit that wall very easily. I mean, I would think that wall would be somewhere before negative 5% global average interest rates. So we'll see. You know, there's no way to know, but exactly when it happens and exactly what the details of the consequences are. But they'll be bad. And I suspect it'll be sooner rather than later because this can't go on much longer.
We'll have more with John Rubino when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino. John, if we hit that wall that you talked about, what's that going to do to the price of gold?
Well, hitting the wall, it's less clear because that's going to be a really chaotic time. But on the way to the wall, as we cut interest rates further and further, that's generally, theoretically, good for gold and silver because gold doesn't pay you any interest as opposed to, say, a government bond. So if you're putting your money in a safe place and you've got a choice between gold in a vault and a treasury bond yielding you 3 or 4 or 5%, the treasury bond has a big cash flow advantage. But if we're going to cut interest rates to zero or negative numbers, then bonds lose their advantage over gold in terms of cash flow, and gold maintains its value, its advantage over bonds in terms of safety. You know, gold is a higher quality asset than a treasury bond. So you would think that more money would flow into precious metals as interest rates fall this time around. And a couple of other reasons for that are that in the last cycle, gold went down even as interest rates went down, but all the world's central banks, or almost all the world's central banks, were selling gold. And now, very few central banks are selling gold, and most are buying gold. So we're seeing, in the aggregate, dramatic increases in central bank gold buying. In part because they got rid of so much of their gold, they don't want to get rid of any more. And in part because central banks see the writing on the wall. They know what they're doing to their currencies. And they know that gold cannot be inflated away and will rise in value relative to these currencies that are being inflated away. And that, gold on the balance sheet of a central bank will help back that currency, because that'll be an asset with a rising valuation in local currency terms. So they're all buying gold in concert with China and India and Russia, who are always buying gold. So those guys have just kept on buying, and now the other central banks are coming in. So you've got that new buying pressure. At the same time, the relative cash flow situations of risk-free assets are shifting in gold's favor. So I would say the process on the way to the final collapse of the global currency system is favorable for gold. Now, when the system starts to spin out of control, the question becomes, is it going to be a 1930s-style deflationary crash in which we wipe out this debt by defaulting on it? In other words, everybody goes bankrupt, they don't pay their debts, everybody's thrown out of work, and you have a Great Depression with capital D again. Or will the central banks just keep on with the stupid failed policies that they're currently pursuing and try to inflate away their debt, even if it means dramatic devaluations of their currencies? And, I suspect that's probably what they'll try, just because that's all they know. If there's a 1% chance that will work, and the alternative is a deflationary depression, which is 100% guaranteed to be bad for their careers, central bankers will try the thing with 1% chance of success. So if that happens, and we have a currency reset, either a controlled one in which governments just announce a devaluation, or a market-based one in which the price of all these currencies just collapse in terms of real stuff, that's great for gold and silver. So we could see one scenario that's possible, that over the next few years we see a steady increase in gold and silver, followed by a completely vertical spike, where they go, up some multiple of 100%, where they go up dramatically in a straight line as these currencies collapse. And in local currency terms, at least in some countries, gold and silver go to basically infinity because the currency collapses to virtually zero. So that's a very conceivable scenario based on what we're doing now. And so it just becomes a question of timing. Does gold and silver go up for 3 years, 5 years, 7 years before it spikes, or does it just go up for a year or two and then spike? We can't know that. But either way, they're good things to own because their general trend is going to be in the right direction. Because the general trend of the global financial system's monetary policy is in the wrong direction. So as long as the global financial system is making these mistakes, you know that real things are going to trend upward in fiat currency terms. And gold and silver most of all, probably.
We'll have more with John Rubino right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with John Rubino. John, with gold maybe going up if we hit some kind of financial wall, what's going to happen to the U.S. dollar and other fiat currencies?
Well, they're going to die, a lot of them, because history says that when you reach a certain point of currency creation, the markets figure out that it's the government's explicit policy to devalue their currency basically forever. And so people act accordingly. They bail on that currency and they buy real stuff. Whenever they get paid, they convert their currency into things that governments can't make more of. And this takes on a life of its own. There's nothing the government can do about it at that point, because to raise interest rates to stop the decline in the value of their currency blows up all the bad debt that's out there and gives you that 1930s style depression. But to keep on printing new currency means the value of the currency continues to fall, and that becomes destabilizing. So that's what's happening around the world, and that's what's coming for us at some point. And, it's not clear whether it's going to be the emerging markets who blow up first, or Europe, or Japan, or the U.S. We can't know which domino falls first and knocks the other ones over. But once they start to go, it's going to be hard to imagine a solution, because we had something similar to this happen in the 1970s, except that our finances were already in pretty good shape. So when inflation started to pick up, I think it peaked at like 14% in the 1970s in the U.S., we were able to raise interest rates dramatically to stop the erosion in the value of the dollar. At one point, we had a Fed funds rate that was pretty close to 20%, and we had long bonds yielding 16 or 17% in the U.S. And we got away with that, even though it caused a really deep recession in the early 1980s, but we survived it, and that was because we really didn't have that much debt. When you look back at the finances of the United States, both public sector and private sector, at that time, they looked pristine by today's standards. People just hadn't borrowed very much yet at that point. But now the opposite is true. We borrowed insane amounts of money. So if we tried to raise interest rates again, imagine what our housing market, for instance, would be like if mortgages were 10% or 12%. Nobody would buy a house. And anybody who had to refinance a mortgage because they have, for instance, an adjustable rate mortgage that's coming due, would just have to give up the house. They wouldn't be able to cover a tripling in their mortgage costs, or the interest cost component of their mortgage at least. So the same thing is true of pretty much every other part of the U.S. economy. If car loans were 12%, or business loans were 9%, going up to 15%, nobody could function. We would just have mass bankruptcies across the board. We have a huge, for instance, energy sector in the U.S. that financed itself with junk bonds, many of which have to be rolled over at some point. So say that junk bond was yielding 6% right now, and junk bond yields go up to 18% if we're replaying the 1970s. That oil driller is bankrupt. And so are all the other oil drillers in the same boat. So we would have this mass of defaults that would give us a depression in a heartbeat if we tried the old fix for what's coming. And there are no other fixes. There's nothing else we can do to avoid a massive devaluation of the big fiat currencies going forward. So I don't see a solution, which means there are only questions of timing, and there's no way to know when it happens. But it is definitely coming at an accelerating rate because we are ramping up our leveraging of the system by running bigger government deficits and pushing interest rates down further and reinstituting quantitative easing. We're doing all that stuff that is leading to an increase in the amount of debt at an increasing rate. So I don't think there's any question now that this blows up on us in the not-too-distant future.
Could governments, say through the UN, just declare, well, government debt over a certain percentage is wiped out, and we're basically starting at zero again?
Well, I mean, they have the probably statutory ability to do that, but the amount of money that's in the system that was spent after they borrowed that money is still out there. So they're still creating huge amounts of new currency. And the people who own government bonds consider them to be an asset, a risk-free asset. So if the government just declares that government bonds no longer exist, then the pension funds and the retirees and everybody who own those government bonds have kind of a problem. So, it's not clear technically how it works, and it's not clear that it would fix anything because it wouldn't lower our deficits or anything. I mean, we'd still have to borrow huge amounts of money to finance the system as it's set up, because getting rid of the debt doesn't get rid of your, for instance, Medicare obligations or your Social Security obligations or unemployment insurance or any of the other obligations that governments around the world have. They still got to pay off. So if they try to eliminate their debt somehow as a way of protecting the value of their currency, then they still have to come up with the currency from somewhere to pay off all this stuff that they've taken on. And that just means they've got to increase the value of the currency, or the supply of the currency out there. They've still got to create new currency. So a debt jubilee is the name for what you're describing, Jim. Has a lot of emotional resonance for a lot of people, but it probably won't work technically. So there are no ways out of the mess that we've made for ourselves, in other words.
Well, in both Canada and the U.S., we've had governments who have spent incredible amounts of money and have run up huge deficits in so-called good times. What happens to their deficits and debts if they have to support a lot of people in a recession?
Well, that's the thing. Recessions are expensive. A lot of people get laid off, as you said, and the government has to pay for them one way or another. And a lot of companies go bankrupt, and that creates a lot of new costs. And then the government feels like it needs to ramp up spending in order to counter all of the negative effects of the stuff that's going on. So they have to increase deficit spending. And, as I said before, they usually double it, at least. They double their deficits from the lowest point in the previous expansion to the highest deficit point in the depths of the recession. But this time around, if we're already $1 trillion plus in the U.S., and we're going to double it, then we're going to be running $2.5 trillion deficits. And it's just not clear what that means. That's just so much money to create and dump into the financial system, because that's basically what it means. When the government borrows money, or when the government just creates it out of thin air, which, by the way, is the next policy choice that a lot of people are pushing, something called modern monetary theory, where we just dispense with the whole taxing people and borrowing money thing that governments do, and then just have the central bank print whatever we need or create it electronically. And in that way, just self-finance by creating money. So if we do something like that, that's kind of the last stage of most hyperinflations, or of the entry to most hyperinflations. It's basically just debt monetization. So that's probably what we'll do. And if there was some kind of a debt jubilee, it would probably be part of that process where we're just creating huge amounts of new money and in effect paying off our debts with it. But that money then is in the system, so it increases the supply of it, which, other things being equal, decreases the value of each individual piece of it, which is inflation, So we can't really avoid a collapse in the value of the currency. And that's something that nobody seems to get anymore. You hear this on both the right and the left, that in the richest country in the world, we should be able to, protect our interests overseas or supply people who need stuff with all the stuff that they need: free education, free health care, free housing, and don't worry about how to pay for it. That's backward thinking. Let's just do what has to be done, and then once we've done this incredibly important thing, then we'll figure out how to pay for it. And that is also it's a mindset that usually comes along towards the end of a long cycle, when a country has basically just given up on any sense of self-control, and we're there now. No matter who gets elected this time in the U.S., we're going to be running massive deficits. We've got the small government Republicans supposedly in office right now, and they're running trillion-dollar deficits. The Democrats in the U.S. are increasingly dominated by socialists who have that attitude I just talked about, that in the richest country in the world we should be able to, and then, name your list of stuff. And so if they get elected, if they take power, they'll probably increase deficits even faster than the Republicans. So either way, we're headed off that cliff. There's really just no solution now, which makes gold and silver a kind of a restful investment, because if there's literally nothing that can happen that contradicts the precious metals thesis, then you can buy that stuff and just relax, because your thesis is correct. It's going to work out one way or another, in one time frame or another, because there is no solution to the mistakes we're making.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and John Rubino. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm talking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, you've been burning up the phone lines the past week.
Yeah, we've had a lot of conference calls on various things, talking due diligence calls, financing calls, meetings, and going down to Cometco and seeing the progress there, which is excellent, and sitting here on our hands waiting for the patent to be issued. And so it's been an exciting week, considering that I had a real bad case of the flu on Monday. I'm getting over that now. But we got some interesting attachments in this week's podcast. Mike Hoy out of Nebraska, who's put together a letter on the EV, the money that's being spent on EVs around the world. And specifically, it looks like there's been $90 billion committed, according to a Reuters article that he's talked about in his letter. And that's going to entail about $19 billion worth of EV cars, 21 in the U.S. and 21 billion in China. And of course, now the gorilla's in the room. Germany is outstripping them by more than a double, and 52 billion they're talking about, 40 of that from Volkswagen. So that tells you something. It tells you that, hey, this EV car has reached a critical point where it's going to be out there. It's going to keep increasing the growth of the sales of EVs.
And if you've ever been in one, it's hard to turn back to an ordinary car anymore, a gas guzzler. So, because they're a unique car, and it's really got some advantages that other car makers don't have. That's great for the environment. And but just to get back to the article that Mike has penned, it's in the attachments, and he's really talking about the growth. Writers are talking about the growth. He's penned a lot of articles to this, and I would recommend that everybody take a look at that, because that'll give you an idea of where the EV car business is today. And while I'm at it, Mike can be reached at, he's in Nebraska, at 402-483-4484. And I would recommend that as a must-read. Now, getting down to other situations, my own comparisons are, if there's $90 billion going to be spent on EV cars, how much is going to be spent on recycling batteries? My estimate that it's way less than $100 million. And, we certainly are happy with our results. And in that regard, I would just like to remind everybody that there's going to be lots of competition out there. But they won't be using our unique process and having knowledge, and certainly having Cometco research. We're not seeing anything that could come up that's any better. That's better than ours. It's just, we got a very small cost of reagents, and depending on size, we can reduce the cost of labor, and and it's not a high cost operation. With the MOU that we have in the Netherlands, they have a method of actually shredding and delivering the cathode material, and they have no cost on that, because they capture they discharge the batteries, they capture that power, put it into storage, and use it for running their plant. And, it may even result in it could run an entire plant, which is our metallurgical process as well. So those are all pluses, and it's hard to compete with that. But I'd like the listeners to know that competition is good. I've been in situations where I had no competition, and it was very hard to sell. And but the more the competitors came out there, the greater the focus became on us, and we increased roughly 30 times the market cap. So competition is good as far as marketing our material goes. We're talking to people that understand marketing, and we have some definite steps that we're going to take. I'm not going to talk about those definite steps at this time, but we are looking for a joint venture partner that sees the opportunity. This is a very big opportunity to be involved in a growing industry. When you look at it, we've got a renewable resource. Every year there's going to be more and more batteries coming free. And whereas in mining, when you're producing the cathode materials, you have a depleting resource. We have can sit down at a desk, and anybody can sit there and calculate what amount of material we have in a battery. We don't have to get permits to drill. We don't have to hire helicopters to take us out to a drill. In some cases, drilling program, and it's just really is a big plus to be involved in the recycling end of it. Like I say, a renewable resource. I think there's 3 million EV cars out on the road today since the beginning, and that's only going to grow exponentially. And we're going to have, at some point, we're going to have half of the cars out there that will be on the road will be EVs, and they all have a battery. So that's the end play for us, is those batteries. And, I couldn't be happier with the progress that's going on. I know that's been a bit of a wait for the permit number to be issued, but that could happen now, any day. I would expect no later than next week. So, I couldn't be happier. I mean, I'm a little under the weather, but I'm not unhappy about it. I mean, the fact of the matter is that the program is going well. We've got it in good hands, and like you say, our patent will cover us off. Nobody could use that specific metallurgy that we use. And we have a few more IPs coming up, so that could reduce the cost further in reagents, etc. So these are all pluses for the company. And I'd like to wish everybody a great weekend, and I'm certainly looking forward to it. So just to let you know, you can get any information you want on the company at AmericanManganeseInc.com. You can phone the company at 574-4444. I'm sorry, I said that wrong. You can phone the company at 778-574-4444. And you can reach me at my email at LREAUGH@AMYMN.com. And you can find our stock symbols. We trade on the Toronto Venture Exchange under the symbol AMY. We trade in the U.S. under the symbol AMYZF, and we trade in Frankfurt under the symbol 2AM. And just to finish off, I think somebody will recognize this here sooner than later, that this is a commercial opportunity of great potential, and we'll get that big partner we're looking for.
Larry, have a great St. Patrick's Day.
Thank you. Happy St. Patrick's Day to you, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 15th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Jim, what's going to be happening in the Golden Triangle this spring?
Well, not much in the spring, but it's going to happen in the summer. What we've got planned up there this year is we'll probably start out with 5,000 meters of drilling, and the whole concept there is that it's easily expandable. We've got enough money in the till to do a very large program. So, we've got a number of zones that we've identified. Now that we have new pads, the allocation for new pads and permits are in place, we can actually move the drill into various positions up there that are going to afford us, better attempts at success that we had last year. We were limited. We only had 9 pad locations we could work off of last year. We got new permits for 40 new pad locations, so it kind of opens up the whole boundary zone to us. We'd like to go back in and test that Noranda hole that's 200 meters to the south of the north boundary, which was, equally as high grade as what we had discovered in the north boundary, upwards of 300 some odd grams per ton over a meter, and we haven't even gotten close to that one yet. We've got a zone to the north of the north boundary that we did extend some holes up towards this area to the north, and they were all mineralized, but the 3D is showing us a big hole there that we could put a couple more holes in there and probably get some joy, we hope.
We've got the south boundary zone, which we drilled last year, got the market pretty excited about it. Not as high grade, the 3 holes, but very, very broad intercepts of lower grade, like 3 to 6 gram stuff. That basically is telling us that we're in an area that we, if we had better pad locations, we would have drilled there a lot more. So we have that ability this year, because I think when you start seeing those kind of zones, and like the north boundary zone, you want to drill more holes, and lo and behold, you could come up with what we hit in the north boundary zone. Those were spectacular, 6 meters of 62 gram. That's pretty nice. And then we've got a zone to the south, way to the south, very southern part of the Forrest Kerr property. There is a big geophysical anomaly there. There's surface and silt and rock sampling just to the north of it that's very rich in gold. That's not been drilled, and we would like to test that. We would like to drill through that, what looks like a high-grade gold system at surface, from the sampling, through that and into that the geophysical anomaly, because that's never been drilled, and it sort of sticks out like a sore thumb.
Jim, for people who are just new to Aben, what are you guys all about?
Well, we're a gold exploration company, primarily targeting for higher grade discovery. That's why we're in the Golden Triangle. That's what it's known for. That's what makes it unique. It's not uncommon to hit very high grades. Eskay Creek is right beside us. Where our property's kind of halfway between Eskay Creek and Snip, and those were two of the couple of the highest grade mines in the world when they were discovered, and they operated for 1 to 2 decades. So that's what we're looking for. Now up north in the Yukon, we're going to go and do a program there. We want to extend our season, so we can get in there and probably early May, late April, well before the Golden Triangle, because they don't get as much snow. The Golden Triangle is closer to the coast. The Justin is on the east side of the Yukon. It's tied right on to Golden Predator. Hauling Road runs right up the valley beside us. It goes up to the Cantong mine. Back in 2011 and 12, we drilled a series of holes. I think it was about 19 holes. We hit gold, and 14 of them we discovered an intrusion-related gold system. And now in the last few years, with sampling program and trenching, just about 1.5 kilometers to the west, we've uncovered a zone we call it the Lost Ace, because it looks very much like 3 aces that Golden Predator has. It's in the same formation, Yusezu formation. We're in the upper formation of it. This is expressed at surface, and that produced some very high grades. If you go to the website, you can see what we've taken out of there in basic trenching. I mean, very high grade stuff. And we want to go and drill that with a Reaugh drill, which is a smaller track-mounted air blast system, rotary air blast. You can do a lot of 50-meter holes very quickly. And then we want to do a diamond drill program around the intrusion on the POW zone that we discovered in 2012 and drill more holes there. That has the potential to be something, like intrusion-related gold systems are generally quite large, lower grade though. So what we might have here is some overprinting, 2 different systems beside each other. One's older than the other, and it could be quite exciting.
Jim, where are you traded and under what symbols?
We are traded on the TSX Venture under the symbol ABN. We're in the States, the OTCQB, ABN.V, and in Europe or in Frankfurt, E2L2.
Jim, thank you so much for the update.
You're more than welcome.
My guest has been Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on March 15th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of House Street Media Incorporated.